everybody, thanks for taking the time to watch this video. Today I'm going to focus on financial planning. However, I'm going to focus on the tax efficiency side of things. In my experience, most people like to focus on the investment side of things. It can be very rewarding when you make money, if not addicting. However, it's often a double-edged sword. In order to make more money, you're often taking more risk. I find the financial planning side of things, especially with focus on tax efficiency, is more of an asymmetric benefit. That is, you can get more upside without adding additional downside risk. Unfortunately, I think the financial industry focuses mostly on selling products for commissions and raising assets to charge their fees on. I think they generally neglect financial planning. For example, you can probably recognize some of the famous stock pickers that I'm showing here. However, you probably don't recognize any of the top financial planners in the country that I'm showing here as well. So I hope this video is going to be helpful in explaining some of the topics that are related to financial planning for tax efficiency. In this video, I'm going to be focusing on income tax. Now, there are other areas of tax efficiency that I'm going to address in some other videos down the road, but today I'm going to focus on income tax efficiency. So what do I mean by income tax efficiency? When you earn money, you generally pay taxes on it. However, there are different ways, different tools we have in order to help minimize the taxes we pay throughout our lifetime. The typical pattern for somebody's career is that they start out earning some money, not very much, but then they increase that amount throughout their career. Accordingly, they end up paying higher taxes as they poke their head up into higher tax brackets. Of course, there's one really easy solution to paying less taxes, and that's to earn less money. But I don't think that's a prudent choice for most of us. So I'm going to focus on tools and strategies in order to minimize the amount of tax we pay on the money that we do earn. One of the best and easiest tools we have at our disposal are retirement accounts. By contributing money to retirement accounts while we're working, we effectively don't pay taxes on that money while we're working and poking our heads up into higher tax brackets. In most cases, we're able to take that money out and pay taxes on it in retirement when we're no longer working in lower tax brackets. This concept is so important, it's worth stating again. When you put money into retirement accounts, you effectively don't pay taxes on it while you're during your career when you're earning and poking yourself up into higher tax brackets. By taking it out during retirement, when you're in lower tax brackets, you lower the amount of tax you pay on those earnings. Depending upon the situation you're in, for example, a W-2 employee versus being self-employed, there are different constraints on the amount of money that we can put into our retirement plans. W-2 employees typically have 401ks, 403bs, retirement accounts that we can contribute to. And often our employers will match part or maybe even our entire contribution to those retirement plans, which makes it a really good deal. For self-employed folks, we have different options. We have SEP, simple IRAs, and we can also set up personal defined benefit plans. I'll leave those as a topic for a future discussion, but the idea once again is to get as much money as we can into our retirement accounts so that we don't pay taxes now while we're in higher brackets, and we eventually take that money out and pay taxes in retirement when we're in a lower tax bracket. As I mentioned earlier, when you're working, you're not going to shoot yourself in the foot by earning less money just to pay less taxes. You're going to earn more money and you're going to pay more taxes most of the time. However, when you get to retirement, that's when we have a lot more tools at our disposal. One of the most popular retirement tax planning strategies makes use of Roth Conversions. Between the time when you retire and before you take Social Security, but also before you're forced to take money out of your retirement accounts via required minimum distributions, RMDs, there's often a period between when you retire and that Social Security and RMD phase where you find yourself in lower tax brackets. That's a really great time to transition some of your retirement accounts to Roth accounts. That is, make use of those low tax brackets to move that money past the tax line. The natural question that comes up here is, how much money do I convert to Roth and when? This is a very involved question and it depends on your own personal circumstances. I think it's virtually impossible to do these sort of calculations, to optimize these sort of calculations without financial planning software. At the same time, I also think there's personal details that even financial planning software packages can address, and it's important to take advantage of any potential other areas to save in taxes as well. One example of an angle that I think financial planning software packages miss out on is beneficiary strategies. For example, you can use disclaiming strategies, or you can set up strategic beneficiary designations so that money that hasn't been taxed yet, for example, traditional IRAs, goes to your lower earning beneficiaries and is thus going to be taxed at a lower rate, and sending Roth money over to your higher earning beneficiaries. I tried to give you a broad overview of the issues involved in financial tax planning, specifically around income tax in this video. There are other topics that I'm going to address in future videos, such as asset location, exchange traded funds or ETFs and their embedded tax efficiencies, tax loss harvesting, and other issues. So if you have questions about this content or any of these other issues, please feel free to reach out in the meantime.